Coming to you raw and unscripted. Beaming across Ontario and beyond to places like Dunnville, Grimsby, Huron Ridge, and Timmins. This is the Real Hickson Real Estate Podcast. Whether you're listening on your commute or putting on your suit, whether it's your morning stroll or you're on patrol, you just finished prayer or dropped the kids at daycare, you're in the bar, your car, or listening with the bathroom door ajar, near or far, this is the Jess and Giro Show. We're grateful for flattery and prone to inaccuracies. This is your guide to Toronto culture, people, events, news, but most importantly, real estate talk. Yes, guys, we are back for another installment of the Hickson Real Estate Podcast. Now, I have with me the lovely Jessica. Say hello, Jess.
Hello.
And this week, as you may have seen in the promo on TikTok or Instagram Reels, wherever you may have seen it, we have the one, the only Shawn Stillman from mortgageoutlet.ca. How you doing, Shawn?
I'm great. Happy to be here.
Thank you for coming in. It is such a point of contention right now. Interest rates, mortgages. It seems like I can't go to a party right now without hearing someone's woes or someone's questions about this kind of stuff. So I just thought, what better way to approach it and deal with it is get the guy in here, the mortgage expert of experts, and just kind of demystify some of this information and see that we can't give out as much advice as possible to people that may be in different positions, good, bad. So let's start off. Introduce yourself. Tell us what you're about, Shawn.
Well, my name is Shawn. I've been a mortgage broker and agent for the past 13 years. I'm currently the principal broker and co-founder of Mortgage Outlet. We have over 200 agents, and last year did $1 billion of volume. My background is I'm an accountant, a CA, CPA, so really love delving into financial statements, investment properties, the hard files where other people say no, I find a way to get you a yes.
I definitely like a creative mortgage broker, that is for sure.
Yeah, but creative you have to be careful about because it's not creative in creating papers. It's creative in finding solutions.
And that is definitely something to note. But let's define it here because there is the Treb and all of Rico has brought up problems with mortgage fraud. Do you hear stories?
Yeah, and it's quite often that we see fake documents. Probably once or twice a month we get a file,
right,
and the documents have been altered in some way. And a lot of times they don't have to be altered, but people are chasing the lowest rate versus getting approved.
Right.
And one thing that people and borrowers don't realize is lenders share information. That if you do fraudulent Scotiabank documents, and Scotiabank finds out, guess what? They know, the lender knows, and soon all 5 banks are going to know that you've doctored documents, and you get put on blacklists.
Yeah, it's definitely not worth it. But I think the important point is here, maybe that some people that don't understand the process have never been through it before, or maybe they bought something in the 80s and it has to come up. The information you can know beforehand, before whether it's a new purchase or whether you come to renewal or refinancing, just understanding and getting the education on little things you can do, building your credit, all those kinds of things will it's definitely important to know.
Yeah, and planning ahead allows you to create a paper trail that lenders will accept without fraudulently creating it at the last minute. Mm-hmm. So for example, if someone was buying a house and they have a cash business or a waitress or a dog walker, the simple answer is for deposit the money in your account, create that paper trail, and then we have a track record to get you an approval.
Yeah, and it's something worth noting. I mean, you talk about lenders, and we'll kind of get into the guts of that. We've done this before with Lena, so the basic concepts are there, and you guys, if you want to go back and check out that, there was a great special with Lena, and we went through kind of the basic concepts of mortgages. But for lenders, like the straightforward, I work at this job and this is my salary. But I'm sure nowadays in 2023, more often you're seeing a lot of different versions of employment, self-employment, and all that kind of stuff.
Yeah, exactly. And the one thing to remember is you have a choice. Do you want to pay more income tax or do you want to pay a higher interest rate? And it's a simply, which one do you want to choose? Yeah. And yes, I could get you a mortgage with a bank, but you're going to have to pay $30,000, $40,000 of income tax to show that income. Or do you pay a little bit more interest
over the lifetime of the mortgage?
Exactly, and then write it off. So, once people delve into their choices, and I always say, talk to your accountant. Do you really want to show this amount of income on your taxes? And usually they say, yeah, I'm happy paying the higher interest rate, and they realize it's a trade-off. You can't have low income for tax purposes and qualify for a mortgage. Yeah. They don't match up.
Yeah, I mean, even we've had conversations about that. It's always a catch-22, especially us, Jess and I being self-employed, deductions and write-offs and all that kind of stuff. It's a balancing act for sure, right?
Yeah, and there's little things like, if you're self-employed, you get to write off your meals, you get to write off your automobile expenses, you get to write off a home office, you get to write off advertising, insurance. It's always best to pay as little taxes as possible.
Yeah. But there's alternate solutions, and you don't have to forge any documents to do this.
100%, yes.
Just call Shawn before you do anything.
This is what I'm saying. When I say creative, I mean, it's not just the banks anymore. It's also the B lenders, the credit unions. Can you talk a little bit about how that's changed over the years?
Yeah, so historically, the mass number of Canadians have gotten prime or A mortgages from the major financial institutions, the 5 major banks. But now that's fallen to about 70% of the market, which means approximately 1 in 3 people do not qualify for an A or prime mortgage anymore. And they're going to credit unions. And the beautiful thing about credit unions is that because they're provincially regulated, they qualify at the non-stress test rate. They also have a lot of flexibility, going to a 40-year amortization, looking at other options. The rates are higher. We have alternative lenders who are sometimes part of banks, get funding from banks, but they do charge a higher rate. Usually there's a fee involved as well. And they're more flexible. They'll look at bank statements, they'll look at contracts, they'll look at bank deposits to qualify for your mortgage. So there's a lot of solutions out there, and it's finding the right one that meets your needs to get you the mortgage approved.
Yeah, it's a good point. So now looking at, what's actually happening in the market, I always like to, the first part of this podcast just to see what's going on in the market, and Jess is going to jump in here as well. Now, in terms of what's happening, we did see, obviously, December, January was a little slow. We saw February, March. If you go back to previous podcasts, you can follow along with this as well. We saw a bit of a jump, and the first interesting thing I want to point out here is usually when interest rates are rising, since the first quarter and the second quarter, usually as interest rates are rising, prices are generally dropping, but we didn't see that this year, did we?
No, and that really comes down, especially in the GTA, to immigration. The number of people that are moving to Toronto, both immigration from outside of Canada and migration within Canada to the major cities, has continued, creating a simple supply and demand conundrum that basically there's not enough new units, there's not enough places for people to live, and the prices are remaining stable. And that's going to continue. It's the federal government's goal to have immigration continue, which is tremendous. We're a country of immigrants. And finding this kind of balancing act is going to be tough to meet. And there's going to be upward pressure on prices and housing demand just simply because there's not enough supply.
Yeah, I mean, just quickly talking about the economy, and we will get into this a bit more, but the term reshoring, which is where they're, especially America, Canada not as much, but just bringing manufacturing and certain industries back to North America. And, we've obviously seen the technology boom, but, we're now talking about EV manufacturing in Ontario and just really focusing on that. And that's completely supported by this wave of immigration. I mean, it was pent up from the pandemic, and yes, there was a recorrection for that, but just a lot of people looking at Canada and Ontario and Toronto as the best place to be living.
Yeah, and if you look at cities kind of as brands, like if you're an English-speaking person in Pakistan, in India, in African countries, where do you want to move right now? London, always good but expensive. Toronto, Vancouver, Canada. The US is pretty much closed to immigration. So Australia. So your choices are limited. And Toronto's
it's
near the top of the
expensive to
list.
immigrate to Australia. Canada's actually one of the cheapest countries to immigrate to.
Yeah.
Okay, so we're seeing the market. We had a strong first and second quarter, relatively. We're noticing things starting to slow down a little bit. I'm curious in the mortgage world. I mean, we obviously have summer, and the reality is people just go and do things in summer, and they think a little bit less about making a move. There are definitely still people making moves, but just from the mortgage side, how have you seen the market kind of change over the last couple of months?
It's definitely slowed down. With the last two Bank of Canada increases, the first one really shocked the market. People were accepting of where interest rates were, accepting that we hit a plateau and maybe a peak of a market, and the first of the last two increases startled the market and basically made people say, I'm uncertain about the future, which really had not happened up until that point.
Yeah.
And individuals who were looking took a step back. Now, what we're finding is because interest rates have gone up by almost 1%, fixed rates over the past 2.5 months, we have people who fortunately have pre-approval still in the 4s, and they're viewing this as, wow, I have a pre-approval in the 4s, interest rates are now in the mid to high 5s.
I better jump in.
I want to jump on this.
Yeah.
So we're seeing that people, there's kind of this urgency now to use up their pre-approvals because they're afraid if they don't get it now, it's gone. And, seeing rates in the 5 and 6% are very scary.
And these pre-approvals are generally for 90 days.
120 days in most
120
cases.
days in most cases. Okay, so there you go. So, it's been a big change in the last 120 days.
Yeah, and what I would say is working with a mortgage agent or broker and having a pre-approval is a tremendous option. View a pre-approval as free insurance.
Yeah.
It doesn't cost you anything. If you don't use it, there's no impact. And the worst case scenario is you get that rate. And I was very fortunate that I have an amazing team, and we did pre-approvals for about 100 clients and just locked in rates when they were lower. And now we're getting calls saying, it's like, well, did you lock in my rate? It's like, yes, we locked in this rate, and they're as happy because they do have that option that they wouldn't have if we didn't do the rate hold / pre-approval.
Yeah, and now you're able to, at least, not maybe with the interest rates, but with the mortgage terms, whether it's a renewal fee or certain other fees associated, you're able to play around a little bit with that as well?
So on your renewal, you're a free agent, and you can either stay with your existing lender or look elsewhere. And the advantage of that is you get to shop and see what the best rates out are in the market. And most time your existing lender is extremely competitive, and over 90% of people renew with their lenders if they don't need more money.
It's just a simple...
Signing a paper, no income confirmation, no paperwork. It's sign in 3 spots and be done. Yeah. Versus if you're refinancing, you have to qualify again at current stress tests, current rates, and current income conditions.
And when people are looking to refinance or renew, what time frame do you recommend?
So we start reaching out to our clients 6 months before the renewal date, just for them to start thinking, do they want a line of credit? Do they need more money? Are they thinking about moving? Are they thinking about renovations? Thinking about what their financial situation is going to be over the next 6 months. So when we hit the 4-month mark and we can start locking in rates, we can hit the ground running and already have a game plan. And there's a lot of times I say to borrowers, hey, we're going to get you approved for this mortgage because this is where interest rates are now. We're going to take that approval and we're going to do nothing with it for 3 months. We're just going to sit on it.
Just so you have it.
Exactly. And you have that in your back pocket, and we could see what interest rates do between now and November, because we're in July.
Yeah. Oh, that's great.
Okay, so just before we dive into the real specifics of all that kind of stuff and just go through a couple more concepts, how do you see the economy going for, I know it's a crystal ball kind of scenario, but how do you see the economy going towards the end of this year and kind of into next year? Because we're seeing a lot of different articles. There is a recession coming. There's a soft landing. We're like achieving this perfect soft landing.
Yeah.
A lot of conflicting articles. How do you see it as your opinion?
So I think Canada is not one economy, and I think we're a subset of many different unique economies, both in geographic, on even a micro level. We're sitting right now in Vaughan, and what's happening in Vaughan is a lot different than what's happening in Hamilton, what's happening in Oshawa. Mm-hmm. What's driving certain places? Are there layoffs? Where are immigrants moving to? What's the supply and demand, and how people are making ends meet? I think as a whole, Canada is probably technically already in a recession on a per capita person. Mm-hmm. And the only thing that's really keeping the economy growing at this point is the immigration that's coming in of almost 1% per year. So if we have 1% growth and we have 1% of new immigrants coming to Canada, basically on an individual basis, we're in exactly the same place. But of course, we have the inflation and the higher prices that are eating away people's savings and affordability. I see this trend continuing. I don't think we're going to have a major recession and major layoffs, but I can see people on an individual basis still to have pain, hitting their bills, meeting their grocery needs. In winter, once natural gas prices come up and people have to heat their homes, they're going to have struggles. But on a whole, I think there's still going to be a very rosy picture. We're not going to see unemployment spike and GDP crash.
Yeah, I mean, there's obviously a lot of external factors that are unpredictable. Yeah. How the Russia-Ukraine war, how BRICS getting together is. We are part of the world here, aren't we, in Canada? Mm-hmm. And there's a lot of unknowns. But also, it's interesting if you look at it in terms of like a small town with one major factory and the whole town. You take the Rust Belt, for example, in America, where all around Illinois and Michigan, those areas that had a lot of manufacturing, that they offshored. And as I mentioned before, now we're reshoring, but those towns were some of those smaller towns were very reliant on that one factory either being A, open, or B, closed. Now that's on a very small level. Now in 2023, especially after the pandemic, where a lot of people, especially maybe younger people going into the entry level, the entry force of the market, they have a lot of alternative jobs now, whether that's, streaming online or just other kind of side hustles. It's not like we're all reliant on this one major industry booming or busting in terms of, propping up the city. It's obviously complex anyways, but I think it's been even more kind of diversified, would you say?
Yeah, but if you look across Canada, we're still a natural resource country.
Yeah.
And unfortunately, our federal government has put a lot of restrictions on a lot of the natural resources, a lot of the mining, a lot of the oil production, and that's from an economic point of view. From an environmental point of view, I know what they're doing, but try to tell that to somebody who's trying to put food on the table that they can't afford their job or they're getting laid off because there's not these productions. So it's kind of this environmental versus individual struggle. And, I think the environment's important, but I also think Canada's a rounding error on when it comes to global emissions. And, yes, we could lead by example and try to save the planet, but what we do is really kind of irrelevant compared to what China does. And unless everyone gets on board, where do you have that balance of helping the economy grow and not restricting the economy versus saving the planet? And that's a balancing act, and I'm glad I don't have to make that decision.
That's for the policymakers. Yeah. But it's important to note, in the last few years that Canada's actually performed pretty well in the economy, and a lot of people have criticisms. I don't know if you agree with this or don't agree with it, but we've actually been doing okay in the last few years since the pandemic.
Well, I think if you're doing well because everyone else is doing horrendously bad, it's a very low bar to measure yourself against. We have been fortunate, our government and the policymakers have put a lot of guardrails on the economy. For every complaint about qualifying for a mortgage, it's tougher to qualify for a mortgage than it ever has, but default rates and arrears rates have been the lowest they ever have, which means something is working. Right, 0.1% of all mortgages at federal institutions are basically in arrears. 15 people out of 10,000. It's like an insignificant rounding
comparing to our neighbors to the south in America, like where the default rate is much higher.
Yeah, and we should never try to compare ourselves to the Americans.
It's tough. Yeah.
It's an easy thing to do because they're the big 500-pound gorilla, and we're, the tiny. I was gonna say the tiny beaver, but like the tiny mouse.
Building our dam on the river.
Exactly. But it's finding. We have to find as a country what works for us, and the housing thing. People have made a lot of money from housing. People are going to continue to make a lot of money from housing because there's just simply not enough of it. And a strong system does protect everyone. People complain, I don't qualify for a mortgage, like it's unfair. But overall, the system has been a great success. And every time there's a rule change, why are they making the rule change? Because the policymakers, mainly from Ottawa, feel that there's some risk to the strength of the financial system. We don't want our banks failing. We don't want to be seeing headlines like we saw in the States, run on banks, Silicon Valley Bank going down. And we don't want to see that in Canada. And their hearts and their minds are in the right place. And you can't really argue that they've been successful. There's been no runs on the banks. Canadians have continued to make their mortgage payments. They were criticizing the stress test 2 years ago when it was at 525. What happens if they didn't have that stress test and people now couldn't make the payments? So, we like to complain. I think it should be the second national or third national sport behind hockey and lacrosse. But the policies they have put in place have been a success and have protected the market.
Yeah. Which is a fantastic segue into, who is the Bank of Canada, in your opinion? What are they doing? How much control do they have over the housing market versus maybe the government? And what has their aim been in the last kind of year of interest rate hikes?
Right. So the Bank of Canada basically controls the supply of money in Canada. And their stated goal is to keep inflation between 1% and 3%. And last year it went up to 8%. And 100 times out of 100 times, if they have a choice whether to bring inflation down or to cause a recession, they will cause a recession because they need to bring inflation down. Because if we don't have faith in what our money's worth, we become Venezuela. We become
hyperinflated money.
Hyperinflated country. And like Turkey's interest rates at 20%. So it's finding that balancing act to keep the value of money, because if people don't have faith in the economy, have faith in the Canadian dollar, everything falls apart because there is not savings, there's not investment. They need to keep that stable amount that the money's worth what we think it's worth, because if all of a sudden it becomes toilet paper, then we become a banana republic.
Now, just quickly, I guess, we could be a whole other podcast, but what do you think the reasons have been for inflation? We had an artificial created market after the pandemic, and an artificially created environment, which is a complete outlier to most history that we've seen before. What have you seen that has had a huge impact on the inflation?
Well, I think there was just money available, and people had access to money they didn't have before. And some of it was government created, some of it was situational created, because all of a sudden people were not buying lunches, were not driving downtown, had more time on their hands, were more productive.
The commuter economy has been the biggest shakeup of all. So many businesses, companies relying on, like when you leave your house to when you're at the office.
Yes.
There is so many things in between that.
Yeah, so that's one thing. And then the government printed billions of dollars, which now they've pushed $1 trillion of debt, that really just pumped money into the economy. They were really handing out money like it was free candy. And now it's time to pay the piper and come back. And, all of this money wasn't free. There was a cost to it. And we're kind of suffering the hangover of the printing press. Yeah,
and I mean, I guess the sentiment, getting back to the Bank of Canada and like, what are their objectives? To me, I always thought when interest rates are low, it's time to take your money out of the bank and use it and spend it and stimulate the economy.
Mm-hmm.
And when they're raising interest rates, it's time to like hold on to a bit more money, no unnecessary spending. Is that kind of the sentiment?
Well, the problem is if you sit on the money and there's inflation, that money's worth less and less every day.
Yeah.
So you should be chasing a return on that money so that you're not losing the money by sitting in the bank account. And we've seen that with banks offering GIC rates of up to 5% right now, which historically they were at 1%. So, you know, I would say don't sit on your money, put it to use in something. And that's depending on your risk tolerance. Is it buying a dividend paying stock that's aggressive? Is it being very risk averse, putting it in a GIC? Is it buying an investment property, which we could get into?
I mean, this is a whole nother podcast. Investment and returns and yields, all that kind of stuff. You know, especially me, the last few years, I've been going through all that myself between real estate and investment. So definitely, maybe we can do another podcast. I don't know. You interested in that?
I'm sure. We'll see what happens. We'll see if you want me back.
Okay, so what is the current sentiment from the Bank of Canada? Where are they at mentally?
I think they don't know. And they were trying to do something called a soft landing, that they wanted to not cause a recession, but lower inflation, which is basically the same with trying to land a jumbo jet on the head of a pin and stopping it on time. Because if they land too short, which is they did initially, they don't tame inflation and they have to increase interest rates, which is what we've seen the last two increases. They raise rates too much, they cause a recession. So I think what we're going to see is, I think we've seen all the increases for now, but I think that they're going to basically say, it's like, hey, if inflation sticks around, we're going to raise them again, because they're going to keep on doing these puddle jumps, trying to hit that head of a pin until they either land it or overshoot it. And the nice thing about it is they're not going to know they're wrong until they're wrong, until it's too late. Until the economy slows down and we start, unfortunately, seeing job losses, then they're going to know that they overshot it.
Yeah.
And there's how many more scheduled meetings?
I believe there's 3 or 4 more meetings this year,
Okay.
but they could also raise rates more than 0.25%. So as we've seen when they raised rates 1% or 0.75%, the number of meetings don't really matter. It's, you know, what does the outlook say as far as what's inflation? Inflation was down to 2.8% last month, which is great because it's in the twos, but still food costs are still keep on going up.
Yeah. So it's not just the inflation rate that they're worried about.
Right. And the one thing to remember is that even if inflation goes down to 0, it doesn't mean that prices drop. We're not going to all of a sudden see red peppers that were $2.99 that are now $4.99 go back to $2.99.
No.
So the prices that we see now are here to stay. By lowering inflation, that just means we're not going to see the increases that we've seen up until this point.
Yeah.
So get used to where we are now.
That's the new normal.
That's the new normal.
I mean, like myself coming from Sydney, when I first got here, I know everyone's going to have a different opinion of it, but for me, coming from Sydney, I thought stuff was pretty cheap here, and like especially housing, you know, and now I kind of getting to, I always make this point that this city kind of belongs to the world now, and now we're getting to this like similar pricing as you would see in other major developed cities.
Toronto does have a lot going for it, also a lot of obviously problems. It took me about a half an hour to get here this morning. But, you know, housing prices on a worldwide basis, as you said, are still fairly inexpensive. Toronto City property taxes are low. Like, they should probably be increased based on that Mississauga's taxes are 1%, Oshawa's taxes are 1%, Toronto's taxes are 0.6%.
Yeah.
So there's a disconnect there. Also, if you think about, we'll go back to the red pepper that's grown in Mexico. Think about something that's being grown in Mexico, being shipped from Mexico, being put on a grocery store shelf that costs $4.99 a pound. Just think of the logistics of that. Is that price going to go down? Like, you know, what goes into that price of that red pepper? And were we kind of spoiled before that stuff was probably subsidized or artificially low, and now we're trying to get the true cost of things?
Okay, so let's go into more specifics of, you know, someone that's staring down the barrel of like thinking about purchasing their first or potentially getting an investment. We'll go through kind of each stage, but for new purchasers, What are people's options right now? What kind of terms should they be looking at?
So we've been seeing most of our clients looking at shorter term fixed mortgages recently because it's widely expected that interest rates are going to fall over the next number of years. Are they going to fall a year from now, 2 years from now? But 3 years from now, they're going to be lower. And the banks are pricing that in. A 1 year rate, let's say, is around 7%. A 2 year rate is around 6.5%. A 3 year rate right around 6%. So people are going to 3 year fix because it's kind of the sweet spot of the first 3 years. And that allows them to pay the higher rate for the next 3 years, but then with some flexibility in the future that if rates drop, they'll take advantage of that. Now, those rates continue to drop for 4 year and 5 year. So 5 year rates are lower than 3 year rates. Now, historically, the longer the term, the higher the rate. So it's an upward curve, except for now it's a downward curve. And at some point, that's going to switch to like a balance curve, like so flat. And then eventually, hopefully, from an economic point of view and an economic outlook point of view, is that rates are going to be going up. The longer the term, the higher the interest rates. So with people choosing 3 year rates, that limits them to, number one, how much they could qualify for. So the current stress test in Canada it's your interest rate plus 2%. So if somebody gets a rate of, let's say, 5.99 on a 3 year rate, then they have to qualify at 7.99 for the interest rate, which puts restrictions on them on how much they could borrow. Now, if I could say to you, we could get a 5 year rate and the interest rate is 5.5% versus 6%, you could qualify for more money because the interest rate's lower and the stress test is lower. So we're finding the only clients that are taking longer term mortgages are either ones that have really good pre-approvals in the fours, or people who need the lower interest rate to qualify based on the stress test. Now, there are really two buckets of borrowers that we deal with. There are the ones who have 20% down and more, and the ones who have less than 20% down. And the ones who have less than 20% down are in a real restricted, because they have to follow the government insurance rules, such as only a 25-year amortization, debt ratios of 39% for your purchase, 44% overall. And because of those restrictions, borrowers are only qualifying for just over 3 times their income, which historically was over 4 times. So if you make $150,000 combined, you could only borrow between $450 and $500 now, which in the past it was closer to $600,000. And that's what's really driving housing prices lower at the lower end of the market.
It's the first-time home buyers that are getting affected.
Exactly. And people with less down payment. Now, if you have 20% down or more, you don't have to follow the government rules. And that's where we're seeing a lot of traction with credit unions who don't have to follow the federal government stress test rates. Banks can make exceptions there to go to higher ratios. So we're seeing, a lot of the people either putting down 20% or more because they could borrow more money, or we're seeing the people at the low end, the first-time buyers, struggling to get to that 20%.
Yeah. And I think how this is going to translate into the market is we saw kind of the detached, the more expensive, maybe semi-townhouse at the very least, increase higher prices than, say, like condos. But I think we're going to start to see a kind of reversal in that. As people have less buying power, they're going to have to start sacrificing on space, location.
And the one challenge is, I think, with a lot of the new build condos, especially in Toronto, is that the price that they were sold at is not going to be supported by the market for ones that are coming online in 2024. A lot of those sales happened at $1,300 to $1,500 a square foot. And they're not, the market doesn't support that now. And so what my concern is individuals who bought, let's say, a condo at $600,000, at 1,400 square foot, it's not going to appraise, and they're going to be forced to look at, number one, either selling it via assignment, selling it after they take possession of it, or borrowing more money and going to alternative lenders.
Now, that brings up an important point of assignments, and that's something that we're kind of focusing on more these days. I think everyone understands pre-construction, and what you're saying is that, the last couple of years, we really saw these baked in future prices, which kind of used to work, but with some of these projections, they're off, and people are paying more maybe per square foot than by the time you get the keys, you get the occupancy, it's built, and you have to go get a mortgage. You're saying that it's not appraising, and you're not kind of experiencing that future, what they projected, right?
Exactly. And in the past, there was the appraisal came back a lot higher than the purchase price. If you bought a condo in 2017, 18, 19, even 2020, you were buying it between, let's say 800 and 1200 a square foot. But now we're starting to see the condos come online, and the appraisals are coming back at exactly what they paid for it. And there's not that capital appreciation that was baked in. And especially that a lot of people don't realize is when you close on a condo, there are closing costs, there are development fees, there's extra money that you have to come up with that the lenders aren't going to finance. And if it's a rental property, you have to pay the HST rebate back of $24,000. So there's times clients come to us with a bill saying, I don't have this $50,000 to close, help me. And if the appraisal doesn't come in, their options are limited. They have to get the money from somewhere.
Right. So if, maybe pre-construction is not the best decision right now, then you look at the flip side of the coin, which is assignments. Yeah. And this is people that had bought at that baked-in higher price, that they're not experiencing that. There is an amount of fees that they're unable to close. In that case, they have to put that property up for assignment. Now, for anyone out there listening that doesn't understand assignments, it's basically the building is getting built. It's still in the process, potentially still in occupancy where you have the keys, but the condominium hasn't registered. You're basically buying someone else's piece of paper that they brought pre-construction.
Correct.
And so in this case, these increased rates, someone is coming to close and having to get a mortgage, whether it's a first mortgage, a second mortgage on this property, whether it be their first or an investment property, and they're unable to close. So their only real option is to put it up for assignment.
And sometimes at a loss, because they have a fear. At a best case scenario, the builder's going to say, I'm keeping your deposit. At a worst case scenario is, well, you agreed to buy this house or condo from me at, let's say, $1 million. It's only worth $800,000 now. You've given me $100,000 deposit. I'm going to sue you for the other $100,000, and I'm going to try. You've entered into a contract. You have to close. So there's been many cases of people selling assignments for below what they paid for them and willing to give up some of their deposit to release them from the obligation. Yeah,
and essentially, if you're buying an assignment, you are paying the deposits that purchaser originally had paid to the builder, and you're, typically, before recently, were paying the profits essentially. But what you were buying was generally a lower purchase price.
But right now there may not be profits to have to pay for.
But that's right.
So it's a good opportunity for people to jump in.
Yeah, exactly. And the one nice thing about assignments is this is where, your real estate experts, you two, come into play and to negotiate this on their behalf. Yeah. Because if you see an assignment that you're interested in, you don't know what the seller's pain point is, what they want. It's like they might not need all the money up front because they just want to get released from the obligation. Or they might need money up front to close on another property. So there's give and take, and there's a lot more, I would say, pure negotiation in dealing with assignments than a traditional resale.
And it's much more common than it was, like, say, 5 years ago.
Exactly, because in the past they were always worth more and they were getting out. Now, one thing that assignments kind of lost favor is from a tax point of view, assignments, when they sell them, are taxed as business income. And they get taxed at the full tax rate, not as a capital gain. So people want to close on them, have the lower tax rates, wait the year, and save on taxes. Now, if they could say it's a business and it's a loss, it becomes,
actually a benefit to
exactly.
A taxpayer.
So have them talk to their clients.
Yeah.
Accountants don't give tax advice.
Never.
And But it does open up the doors of a lot of people where people are being, fearful. Your clients could be greedy and pounce.
Now that's a trigger word for a fantastic saying that you said the other day about being greedy in these kinds of markets. What is that?
Well, so when other people are fearful, you should be greedy. And when other people are greedy, you should be fearful. Mm-hmm. And right now there's a fear in the market. And this is the time for you to be greedy. If somebody is looking for a house, looking for a property, be picky. Negotiate. Get the conditions you want. Get the closing dates you want. Get the price you want, because there's going to be people that are going to have to sell. I was looking at a Mortgage Investment Corp's book of deals the other day, and over 10% of them were in arrears of at least 30 days. 30% of them had loans to value of over 80%. So even though the banks are pretty stable, there's a lot of alternative lenders who have mortgages on their books that are near the tipping point. And all of a sudden, if you have 100 properties in the GTA come on the market because they're not making their payments, that's going to vastly impact them, because the Mortgage Investment Corp, or MIC, wants to get their money back. And once they go through the power of sale process, they just want to get paid. They're not worried about maximizing the value of the house. They want to simply make their money back and move on.
Yeah.
And we haven't quite seen that. All of the foreclosures we've seen have not been from the banks, but have been from the alternative lenders, private lenders, mortgage investment corporations, and that's going to continue, and I can see that accelerating.
Yeah.
Because the borrowers from alternative lenders or private lenders, they don't really have an option. They have to eventually either sell, stop making their payments, or go on, because they really can't refinance because they're kind of trapped where they are. And
I'm guessing that, more often you'd see this in condos rather than, detached. I'm sure it varies, neighborhood to neighborhood, but at least from, the stats that I'm seeing, obviously a lot more inventory in condos are going up, and I think prices are going to reverse quicker than the rest of the market in detached. Townhouses, as we kind of mentioned points about that before, the interesting thing I want to see is we saw from, at least last summer, when there was the release of immigration again, and obviously with a lot of pent up demand, and that kind of correcting the waves and percentages of immigration. Well, a lot of those people, we saw them. We did a lot of rentals. It's not like they're war torn. Some of them are for sure, but they came with good jobs. They came with education, like these English speaking countries that you were referring to before, and we saw, for example, the second-hand car market explode. Why? Well, I think it's because they weren't able to qualify. They had no credit history, they had no employment history to get that. So now, similarly with mortgages, what I'm seeing and what I'm predicting is in 6 to 12 months, maybe a little bit longer, this surge of now these people who are renting, okay, now they have a year or 2 years worth of credit history. They have solidified employment. How do you think that's going to change things?
I think the challenge is they're chasing a ghost, because let's say they're trying to save up for a down payment. Guess what? If the housing market goes up by 10%, they're still not going to have enough down payment. And this is where I advise borrowers and clients, if you can afford a house now, pay the CMHC insurance, get into the market, get onto the ladder, because you need to have that capital appreciation. And
You're part of the growth.
Exactly.
Yeah.
A rising tide raises all ships. You want to be part of this market eventually going back to our normal.
Yeah.
And is 10% growth normal? No. That's not sustainable. But even if we go back to like a 4% growth, that means that your $600,000 place is worth $24,000 more next year.
It's almost impossible to outsave the market.
You can't outsave the market. So, I feel bad for individuals who don't have something saved, or don't have a ability for parents to help them out, because they're really behind the 8 ball, and there's no solution. Like, no one's going to come in and say, well, here's more money, here's free money. The government has a program to give away money for a down payment, and it doesn't work. It's not enough. It doesn't work, and nor does that it helps individuals. And I think it was a good backwards way of trying to help individuals, but it doesn't help people in Toronto. It doesn't help people in Vancouver. It helps people if you're buying in Winnipeg.
Yeah.
And the biggest uptick for that program was actually in Quebec, because everything in Quebec outside of Montreal you could get for a few $100,000. And it really comes back to supply and demand. You know, we have a problem building things. Like, look at the Crosstown LRT. As a society in Canada, we cannot build anything on time, efficiently, and profitably.
And on schedule, on task.
You know, there was an article that the city of Toronto is spending 2 months to replace tracks, I think, on Broadview.
Really?
Right. And they said in Australia, I think it was in Melbourne, it's like they did it in a weekend, right? Like, we have a problem of inefficiencies, red tape, and stuff just taking too damn long. And I'm not saying that we should be building skyscrapers like they do in China in a weekend, because
we need
rules.
We see what happens when you build too quickly, like panes of glass falling off buildings.
Exactly. But there is something that we need more housing. And the thing that I'm worried about is, if we're having this immigration and there's nowhere for people to live, are they going to stay?
Yeah.
And, like, there's two things. Number one is, like, where else are they going to go, which we discussed. Like, if you're coming from India and, like, you come to Toronto, it's like, are you going to go back to India? Now, I've never been to India, but, you know, we all have the stereotypical picture of India.
And if they've left to make a better life, how can you go backwards?
How can you go backwards? But the challenge is I remember that we discussed 20 years ago what the average housing price was in Toronto, of like 300,000, and now it's over $1 million. And, like, how is that sustainable when income hasn't gone up at the same level? So we really need the government to kind of cut red tape. We need to build. We need to have the trades, and we need to be having the right type of immigration. Like, Canada's immigration system is amazing. It's a scorecard. You pass, you know, you speak English, you are between a certain age, you have a job, it's like, welcome, come tomorrow. But we also need to open it up to people with the trades, the bricklayers, stuff that we're not training for people here now, to help build the city. Now, the one, I think, real complaint I have with the city is, like, what do we produce? Like, all that we've been producing really is tiny boxes in the sky, and that's been the main driving of our growth. And we really need to expand on that, which we're doing great through immigration, but we need someplace to have these people live that are not 420 feet.
Yes, like with your family, it's difficult to live in a one-bedroom.
Well, to maybe have a snapshot of the future, like back in Sydney, where I'm from, we went through these same things maybe a little bit, 5 or 10 years ago. Basically now, there's no thought of like, oh, where am I going to live in Sydney? It's just like, I'm not living in Sydney. Unless you have inherited money or investors are coming flush with cash. The reality is people are just finding other places to live in the country. And I think that's what's happening here for some part as well. We're seeing a boost in Halifax and the prices of rentals and the cost of living. I mean, they have a whole thing with gas and utilities there, of course. But I think there will be a necessity to create other hubs. And going back when we're talking about comparing ourselves to America, it's hard to, because the reality is America has major cities all over the country.
Oh, absolutely.
And we really, like, strictly speaking, Toronto is the major city. We have other minor cities, but it's not quite the same level as the GTA. And I guess out of necessity, we will have to create those, and people will create it for themselves. Whether it's maybe in Hamilton creates its own hub over there, or further out in Waterloo, Kitchener. Innisfil has a whole futuristic project coming there. I think Barrie is another example of that. Of just out of necessity, people will create these other hubs.
Yeah, but the thing is, nobody dreams about moving to Barrie.
It's true. It's true. It's true.
And like
it needs a little bit of a marketing day.
Barrie needs to basically improve the market. But when you're coming from India, or you're coming from Pakistan, or you're coming from Nigeria, you've never heard of Barrie. Yeah. It's like, I don't want to.
Yeah, they have an idea in their head where they would like to be.
And Toronto's done a great job being on the world stage. It is perceived to be a world-class city.
Well, when I first moved here, I moved to Yonge and Eglinton. Okay, yes. It used to be called Uptown. Now it's called Midtown.
Yes.
People from downtown used to say, "Sorry, where do you live?" all the way up there. Like, are you kidding me? And now I have the same thing, living in Maple. Oh, all the way out there, they make jokes about bringing their passport. Guess what? In 10 to 20 years, it's going to be so normal. I actually thought it was a bit weird living right downtown. From where I was in Sydney, it's only really hotels and businesses that probably turn to suburbs a little bit quicker. A smaller CBD, you would call it. But the commuter culture was very normal. Now we're seeing the upgrades in the infrastructure, which I think is great. Obviously, it comes with its pains, and I think it's a little bit overdue. I think they try to compensate for this new Toronto that is being formed, this new GTA. But I mean, from Maple to get downtown on the GO train is 35 minutes. I mean, that's so reasonable. It would take longer to drive in most occasions.
Oh, it takes longer to drive down the road.
And I'm going to admit something. I have never been on the GO train in my life.
Really?
Yes.
It's actually a really good experience.
No, it's nice. I think it's a little bit expensive, but you have toilets. You have, I don't know. It's maybe I'm comparing it to other things that I've experienced in different cities. But there's like charging ports. I mean, it's not.
But I live at Avenue Road in Lawrence, right? So
it's
like
there's no GO train.
No, there's no GO train. And I think
the
the subway downtown if I have to go downtown.
Yeah.
But Canada has to kind of meet these hubs that people are not going to downtown Toronto.
Yeah.
And how often do you go downtown? Unless you're going to an event.
No.
You're not going downtown to eat. You're going to eat.
No, you stay around your local area.
Yeah. Okay, so now I guess we should go. That's from kind of new purchases and assignments and investment properties. Now let's talk about people that right now or in 6 months, 12 months, they're looking at renewing or they're looking at potentially refinancing. What are some options that people have?
I think time is your friend right now. I think that we're near, knock on wood, the peak of interest rates. And I would say if you're 6 to 12 months out, I would bet $1. I wouldn't bet more than $1 that rates are going to be lower in 6 to 12 months from now than they are right now. So be patient, listen to what your existing lender has to say, but don't necessarily jump in with both feet. I would always say price what your existing lender is offering with a broker. The best call I could ever say to somebody is, I could beat what your bank is offering. The second best call is, your bank is offering you an amazing rate, sign it. Because you know that you have the best option out there, or I could save you money. So reach out to your mortgage agent, your mortgage broker, and say, RBC is offering me this, can you beat it? I had a call yesterday, and they said, RBC is offering me this, I'm very angry, I'm a good customer, and I said to the client, 589 on a 3-year, it's a very competitive rate, you should take it. And she was shocked that that's how high interest rates were. But I get paid to tell someone yes, I get a commission if we move them to another lender. But honestly, that was a very competitive rate, and it didn't make sense to do it else. Now, what I would really say is, if you're looking to refinance, see what your mortgage payments are, because if you can't make your payments or are gonna have hard stress or a hard time making them, this is the time that we can either stretch out your amortization so it'll lower your payments by stretching your mortgage back over a longer term. We could add a line of credit, borrow more money, etc. So have an honest conversation with your family, internally with yourself, and say, what do I need to alleviate potential stress going forward? Because at this inflection point, that's where it makes time to basically make that decision.
And so, changing any kind of term, whether that be just stretching your amortization, that triggers a refinance, essentially.
Correct. So if you change the mortgage amount or the term, or the amortization period, that will be a refinance. So if the mortgage has to be re-registered on title, so the original contract is changed, then you're in trouble. Now, of course, you could always pay it down. So if you have $100,000 and you're coming for renewal and you want to pay it down, that's not a problem because this contract still stays in place.
Right.
But of course, it's increasing it or changing the amortization.
Yeah.
Or adding a co-borrower or removing a co-borrower. Removing it is slightly easier.
So what will typically happen when you come up for renewal is you will get a notice from your current lender.
Yeah.
Like, for example, we got an early notice.
Yeah.
Maybe they're trying to... Why would they do an early notice? They're trying to get ahead of any changes in the market, the interest rates?
Well, it's partially fear is a very big seller.
Mm-hmm.
So you notice when interest rates are dropping, they're not necessarily offering you an early renewal, because let's say you're paying a rate of 2.99, rates are 1.99 back then they're not going to basically say, hey, we're going to give you a better deal if you lock in. So they're not as aggressively pushing that. But when rates are going up, there's the selling of fear, I find, to try to convince people to renew, because 90% of people renew. Now, the one very interesting fact is I heard from a major bank that 14% of people sign their renewal letter and don't negotiate.
Right.
So always ask questions. I was just on the phone with a lender before we got here for a client getting a renewal, and I got them 0.25% off the rate, just because I said, hey, like this is the situation.
Yeah.
Can we get lower? This is what I need. And they said, yeah, like they'll do it. So ask. It never hurts to ask a question.
Don't accept the first offer.
Yeah, it never hurts to ask a question, because if you don't know, you won't get. You don't ask, you don't get.
Yeah. And in terms of, people, as you talked about, looking at a much higher borrowing cost, especially people that got their mortgages a couple of years ago when the rates were ridiculously low, and now there's been a massive shift. Kind of what other options in terms of like refinancing, pulling out equity? What options do they have there?
Yeah, and it really depends on what mortgage they have. So if they're with a major bank and they have such a product as a Scotia Step or a TD Flex Line, a mortgage that is readvanceable, they could go back to the bank and say, hey, I either want a line of credit, I want to pull some equity out of my house, and they do have a lot more flexibility. And that might help them get over the hump. So all of a sudden, I have $200 a month, I'm shortfall in my budget. Well, I'm going to get a line of credit and kind of make some mortgage payments off that line of credit until my salary increases or until rates go back down in a few years. So having access to money is key, and it opens up options. The other thing I really like is pushing out the amortization. So all of a sudden you're at a 20-year amortization. Let's go to a 30-year amortization. So you're still paying down your mortgage. You're just not paying it down as quickly, but you're not racking up any other debt. One thing I've really noticed is individuals who are still borrowing too much, and it's not from a house, but it's credit cards, it's other debts, and now they thought, okay, I've always been able to refinance my house. Every few years I've pulled out equity, I've paid off my credit cards. That is not there anymore, and that's where we're seeing individuals who are racking up credit card debt and not being able to make those payments. And that's what I would say kind of concerns me. So, if you're living off your credit cards, it's not sustainable. At some point, you're going to have to pay them. And the equity that you've always expected is in your house might not be there.
Right.
Yeah. I mean, it is scary to some people out there. This is what I'm always telling them at the end of the day, like, these interest rates will eventually go back down, and this is a short-term storm. And I guess that's the sentiment. It's just to weather the storm, hold on. That's kind of what I've titled this episode, I'm pretty sure. And, insert cute cat photo with hanging onto the limb, that one. And basically, and that's it. And it's very scary. It's not all bad news. This is short-term. And maybe don't get that extra overpriced latte that you usually get. A couple times a month.
But if you're looking to buy, realize that housing prices have gone down in the same proportion to as interest rates have gone up.
Yeah. What's the term? Date the rate, marry the price? That's essentially what it is.
Yeah. But realize if you could afford a $4,000 mortgage payment before, you could still afford a $4,000 mortgage payment now.
Yeah.
But you're borrowing a lot less money for that $4,000, and the housing prices have almost gone down linear by the same dollar amount. So if you could borrow $100,000 less, prices have gone down by $100,000. And the one nice thing about it is when interest rates go down, the house price is going to go back up.
And
and then
have that equity
you're still going to be paying $4,000. Yeah. But you're not gonna be in. And now everyone else who was sitting on the sidelines are now going to be in the market as well.
Yeah.
So this is the time between, let's say, March and May, June. Bidding wars came back. Now we're not seeing bidding wars.
Yeah.
I had 3 purchases this week. All of them had financing conditions on them because there isn't they can and there isn't the same demand as there was. People went to the sidelines. And this is the time when everyone else is on the sidelines, you have to jump.
Yeah.
You know, there was a fear for the longest time of missing out.
Yep.
Then last March, it switched to a fear of overpaying.
Yep.
Then it went back between March and May of this year, a fear of missing out. Now we're back to a fear of overpaying.
Yeah.
There is going to go back to the fear of missing out. This is the time that you have to look and find the property, get pre-approved, lock in the rate, make sure it fits in your budget, and then from there, call you two and have them go find a house.
And then they call you.
Yeah, and by the way,
call me first so that I can tell them how much you can get pre-approved for.
But that's the most important thing here, whether it's your first or whether you're looking to get into the next one. You know, take the time, Shawn or Lena, and set yourself up with your broker. Open the case, do all the legwork, do all the running around for pieces of paper, whatever, so that when the time comes to make the jump, whether it's now, in a few months, or next year, you're loaded. You're ready to pull the trigger when you need to.
Yeah.
And I think there's going to be a really crucial period. I mean, as you said, now is a fantastic time. Prices, are, if you look on the scale of things since the 1920s up until now, I mean, the last 100 years, real estate's always increasing. And especially with such immigration coming here. And my thing is always, is there going to be one more person in Toronto than there was yesterday? If the answer is yes, well then, there's always going to be a demand for housing. And as long as there's still issues with the inventory, we're going to continue to see, housing prices increase.
Yeah, and also the cost to build them, the cost to build a square foot of a condo, a square foot of a house has only gone up. So the materials going into the house has gone up. They're not making any more land.
Yep, that's what I always say. And the most expensive land is in the air. And, developers are hesitant to, I know they like going up, but it really has to be worth it for them to do it.
Yeah, and there's a lot of pre-sale condo projects that are not selling right now, that they launched and that they're sitting, that they're not getting the pre-sales because they can't. People are not willing to pay $1,600 and $1,700 a square foot. But at some point, it's going to catch up.
Yeah.
At some point, it has to catch up because that's what's going to cost to build, and the builders are not going to build unless they're there.
Yeah.
And, there's not the supply, but there's the demand.
Yeah. But as you said, there's going to be a point to which even one interest rate cut could just absolutely put fire on the market
just
again.
Them holding those couple times.
Yep. Even just holding the rate.
Yeah. People looked at the mountain and said, okay, we hit the peak.
Yeah.
And now it's down from here. And then when there was like, oh shoot, it's not the peak. There's like more up there in the clouds. It spooked them.
But then it goes opposite. It's like, but they could keep raising it, so we may as well. So this 6.5 or 7% actually looks okay.
Exactly so. It has to make sense for you in every way. If you can afford you're right. If you can afford $4,000 today, and you can afford it's not gonna make a difference. It maybe you get less for your money, but it's still costing the same amount every month.
Yes, and I'll just end on one story. So my business partner Elan bought a house a week before Bear Stones went bankrupt in 2008.
Wow.
Right.
And the minute he bought his house, it went down drastically.
Sure.
Wow.
But if he didn't buy that house, he would have not bought in that house because he would have been feared, would have been paralyzed, would have been chugging along and would have waited till the market went up because he would have never bought at the bottom.
Yeah.
And now that house is worth, X times more than what he paid for it because he bought the house, it went down. You're never going to buy the house at the bottom. You're never going to buy the house right at the top. If you buy a house 10% from the bottom on the way up or the way down, it doesn't make a difference. It feels a lot better, 10% on the way up than 10% on the way down. But I bet you probably got the house more you want at 10% on the way down, simply put, because there was less people that you were bidding against. So
and over the lifetime of you having the home.
Yes.
It doesn't matter.
This is a long-term investment. This isn't day trading.
You're not trying to sell in 6 months.
No.
Buy and sell in 6 months.
And by the way, flipping has really drastically dropped, especially with anti-flipping taxes, which is, I think, fair. I think, we have inventory issues, so we should try and tackle that issue of people just flipping for money. But just that alone, it's going away. So, what does that tell you?
Yeah, and flipping there's not the opportunity to flip, and the land transfer taxes in the 416 make it very real estate fees and land transfer taxes.
Yeah,
there's
no
8%. Like you
Yeah.
have to be able to make, 30-40%, and
Yeah.
that just doesn't exist.
Yeah.
And, I guess the sentiment here is hold on. As I keep saying to it, this is just a blip in the lifetime of this investment. Whether you're selling it now, the money, that equity still grows with you. Whether it diminishes or increases, it will just go with the market. As long as you're not panicking selling, which is probably the worst thing you can do, selling real estate under duress for any different reasons, that's the worst. And I mean, okay, you just bought at the peak and the market dropped 10%. You haven't really lost anything until you sell it.
Yeah, and as long as your budget and you're happy with your budget from a cash flow point of view, you can't eat your house, you can't sell your house, you need someplace to live.
Yeah.
Make sure your budget is balanced. Make sure you're comfortable with your mortgage payments. Make sure you could handle, emergency repairs.
Yeah.
But, as long as you make your payments and you don't feel stressed about your payments, yeah, it's terrible when you see your house go down and that your neighbors sold their house for 20% less than what you paid.
Yeah.
But it doesn't matter until you sell.
Yeah.
And it's just about holding on to that piece of paper.
It's all going to be okay. Let's end on that.
It's all going to be okay.
It's all going to be okay.
Yeah, I want to end on one last thing. You're sitting there right now listening to this podcast. You're on a variable, and you're on a variable, let's say, for the next 3 years. And you're riding with the market, and there's no way, you could lock in or maybe not lock in, and there's all this information. What's advice to someone sitting there right now looking at a much higher mortgage repayment?
So, as you said, you can't lock in. There's nothing that makes any sense locking in right now if you're on a variable mortgage, unless for somehow you have a great pre-approval rate or some rate, locking in at the 4s. And unfortunately, it's really just ride it out because there's not really a lot of options. It doesn't make sense to crystallize any of your payments. You're not getting any lower payments. Yeah. But you can do is, once again, stretch out your amortization. I'm working with one individual now, taking her from 20 to 30 years. Lowering her payments is really the only thing you can do. Because that's the only lever you have. You can't change the interest rate. Yeah. If you can make a prepayment, you can make a prepayment and pay down your mortgage. But really, it's the amortization is the only one to lower the interest rate, lower the payments.
Yeah, and I think just making general sacrifices elsewhere until this all changes. And it will.
And next year, this time we'll have the same conversation.
Yeah.
And things will be better,
and everything will be different than now.
Let's do that. Let's do it in 1 year's time. We will have Shawn on again, and we will talk about unicorns and rainbows and how beautiful everything is.
See, this is when you have to ask me for 3 predictions and see how wrong I am with 3.
Let's end on that. 3 predictions.
Interest rate is at a 5-year interest rate is at 3.99
in July 2024.
Yes.
Okay.
For an insured mortgage, so a high ratio mortgage. So I do see that something is
5-year 3.99. Okay, second prediction.
It's Donald Trump is the nominee for the Republicans again.
Okay.
Because there's no one else. There's no one else.
Okay, fair enough. Okay, and the third prediction.
Housing prices have not crashed, and housing prices are up 5% from where we are now in Toronto.
Wow, 5%.
Okay, well, we have it in writing.
Okay.
Because I think we are hitting the peak, and I think that we are going to see interest rates start to be cut. There are rates. Yeah, I think rates are down 1%. The insured rates, if you're putting down less than 20%, are down 1% between now and next year, which gets us to the 3.99. There'll be a 3.99 rate. Housing prices up. And we're not rid of Donald Trump yet.
What? Well, let's see what happens, Shawn. We're gonna have to end it there. So much we could talk about, but we just have to muzzle it for now.
Thank you so much.
Thanks so much for chatting to us. Really appreciate it. You're very busy. Guys, if you have any other questions,
he's
please.
Not too busy to talk to you.
Yeah, exactly. I will probably post this wherever you find the podcast. I'm gonna post Shawn Stillman at mortgageoutlet.ca. Obviously, you can hit us all up. Yeah, at Hickson Real Estate on Instagram, TikTok. We're on all of the major platforms.
Apple Music,
Spotify podcast, all of that.
It's not Twitter anymore.
No, it's not. It's something else. He wants to call it X, I think.
Yes.
Guys, thanks so much, and tune in next time for some more essential advice.
Thanks.
All right, see you later.
Bye.